Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today for the second segment of our show. We're talking about the fiscal cliff. I was on the Phil Knight show earlier today talking about it, and there's just a lot of things to cover. The fiscal cliff, and it's dominating the news cycle today. And what we wanted to do was kind of zero in on some of the impacts for the average American. If you missed the first part of the show, head on over to our website, www.dlblain.com, and there you can pick up an archive copy of the show about in a week or so, both the video or the audio. Download it to your iPod or watch it on your iPad or Android device. It works great on mobile devices. I watch it on my phone all the time. It's a great way to, if you can't listen to the show live, download it from the website and listen to it when you can. A lot of people maybe not listen to their car. A lot of people have the XM radio now and aren't at home when the show is broadcast. So go to the website there and download it to your mobile device. It works great on all of them. I know I use it and test it all the time. Anyway, so the fiscal cliff, we were talking when we left before about the AMT and how it's ensnaring more and more taxpayers, especially people that have high income or high state income tax. Under the alternative minimum tax rules, you don't get a deduction for income tax deduction. That goes away, as well as some other itemized deductions and things. And in this debate about making the wealthy pay more tax, one of the things that escapes me is we already have the alternative minimum tax. And this is the problem when the tax code is so complex and nobody ever sits down at a table like we have here and really hammers out, hey, what's a reasonable tax code? And so you get this layer upon layer upon layer of taxation. And it does two things. Number one, it gives opportunities, frankly, to legally get around it, which I don't fault anyone. I mean, we spend a lot of our time minimizing people's taxes. There's no obligation to pay more than you're required to. And it makes planning very difficult when you have this myriad of tax rules. And so a simplification of the tax code. One of the things I love to look at is look at some of the Baltic states. Look at the former communist states in Eastern Europe. And I know they have problems, but they are some of the biggest beneficiaries of the fall of the Soviet Union. And when you look at these countries that they gained their freedom, in the late 80s, early 90s, and they have that influence of American style republic and constitution and things like that, and you look at the tax regime that they have instituted, and you look at the growth in places like Poland and Latvia and Estonia and places like that, they all have flat taxes. Go to, I think it was Wikipedia or something, or Google, tax rates around the world or something, and there's a great chart, I think it was on Wikipedia, where you can look at each country and you can see sort of the type of tax regime that they have and their growth. And you see that a lot of these former Eastern Bloc countries that have very robust revenue growth, they all have flat taxes. They all have monetary policies that do not include printing trillions of dollars of money. Anyway, so the fiscal cliff that's coming, it's going to affect a lot of taxpayers. And I was mentioning on the Phil Knight show this morning, hey, the Democrats, in my opinion, have no incentive whatsoever to come up with a bargain. And so if you want to blame somebody for going over the cliff, it's clearly to me the Democrats, because January 1st, if they do anything, it looks like a tax cut. And so I'm not optimistic anything will get done. At the same token, I'm not also overly pessimistic that it's going to destroy the economy. I mean, the CBO has these estimates which are notoriously incorrect. I do think it will hit growth. They're estimating that GDP growth in the U.S. would be marginally positive if the fiscal cliff went into effect, somewhere around 0.5%, and then recovery in the second half of the year to finish the year between 0.5% and 1%. So not a complete devastation. I think you would see some effects, but a lot of the effects people are already starting to prepare for. So anyway, that's kind of where we are on the fiscal cliff. I wanted to shift topics to the bear market. We get, in investing, there's a lot of people always are looking for, they want to make a reasonable rate of return. I hear this all the time. Say, well, I just want to make 7 or 8% with no risk. Not possible. Not possible at all. There's a fundamental principle in investing of balancing risk versus reward. That in order to get a higher expected return, and not higher guaranteed return, but you have to assume some risk. If not, the return would not be there. There's sort of a baseline, and for years and years it's been the U.S. Treasury bond. Now, some people would make some argument that Treasury bills and Treasury bonds are no longer sort of the default risk-free asset, but for the purpose of today, we'll still assume that the U.S. Treasury bill has no default risk and is the safest investment in the world. And evidenced by whenever markets start to decline, people are still flocking to the U.S. dollar, which is essentially short-term Treasury bills, or to longer-term Treasury notes and bonds. And so anything beyond accepting the return on a short-term U.S. Treasury bill, you're accepting some sort of risk in attempting to make a greater return than is available just by investing in a safe asset. We're coming up on our second break here. When we come back, we'll continue talking about why bear markets are a necessary evil. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.